For decades, Ghana was bleeding gold. Literally, one of Africa's richest nations, buried in precious metal worth trillions, saw nearly every ounce slip through its fingers, siphoned off by foreign companies, stolen through smuggling networks, and vanished into corporate ledgers. Then, in 2026, something extraordinary happened. In just 4 months, Ghana generated $2.7 billion in gold revenue. Not because they struck gold, but because they stopped losing it. And that simple shift didn't just reshape a nation. It sparked a revolution across an entire continent. This is the story of how one country decided its wealth belonged to its own people, and why the world is watching. For generations, the numbers didn't make sense. Ghana sits on some of the world's richest gold deposits. More than 30 million ounces locked beneath its soil. A fortune that should have transformed the country, built cities, funded schools, erased poverty. Instead, Ghana's economy lingered. Its currency weakened. Its people struggled with unemployment and mounting debt. And nobody could quite explain where the gold was going. The answer was always there. It was leaving. Between 2019 and 2023, investigators uncovered the scale of the catastrophe. Over 229 tons of gold, worth approximately $11.4 billion, had effectively been stolen. Not in some dramatic heist, but systematically through paperwork and handshakes. Foreign mining companies underreported their yields. Smuggling networks operated in plain sight, funneling raw gold through Dubai and other trading hubs. Middlemen took cuts at every stage, and the nation that actually owned the gold got crumbs. For a developing economy like Ghana, $11.4 billion wasn't just money lost. It was hospitals not built, schools not staffed, jobs not created. It was economic potential literally extracted from the earth and emptied into foreign bank accounts. The math was brutal. Every ton of gold that vanished was a town's future disappearing with it. But here's where the story shifts. Because Ghana wasn't powerless. It just hadn't recognized its own strength yet. The turning point came from an unexpected source. Ibrahim Traore, the military leader of neighboring Burkina Faso, had begun experimenting with something radical. What if a nation treated its own resources like its own resources? In 2021 and beyond, Burkina Faso implemented strict state control over gold production. They banned raw gold exports, forcing miners to process domestically. They cut out foreign middlemen. They enforced rigorous oversight. And they kept the wealth. Ghana watched. And Ghana listened. By 2025, a new strategy crystallized. Ghana established the Gold Board, a government institution designed to centralize all gold trading. Instead of foreign companies and smugglers deciding the terms, the nation itself would become the primary buyer and seller. The structure was simple but revolutionary. Every ounce of gold now had to flow through official channels. Exporters who tried the old routes faced enforcement actions. Small-scale miners, often overlooked and cheated by middlemen, were brought into a formal system where they received fair prices directly. The ban on foreign middlemen was the key. They didn't disappear, they just lost their grip. For decades, these intermediaries had taken 10, 15, sometimes 20% of the value simply by existing between the miner and the buyer. A government gold board cut them out entirely. That margin, that massive, consistent percentage that had been hemorrhaging wealth, now flowed into Ghana's treasury. What happened next was almost surprising in its simplicity. The money started staying. Export volumes surged. Revenue didn't triple because Ghana suddenly found more gold. It tripled because Ghana stopped losing it. The supply chain became transparent. Smuggling networks lost their customer base when the legal route offered better prices and faster payment. Small-scale miners, empowered by fair treatment and direct access to formal systems, ramped up production legally instead of feeding black markets. And the dominoes kept falling. Because when Ghana's gold started staying in Ghana, something deeper shifted. The psychological weight of the heist, this constant drain that everyone felt but few understood, lifted. Suddenly, the government had real money, real options, the kind of economic breathing room that makes structural change possible. But the story doesn't end with Ghana. What happened in Accra was noticed in Bamako, In Niamey, in Dar es Salaam, Mali watched, Niger watched, Tanzania watched. Across Africa, nations sitting on vast reserves of gold, copper, diamonds, and lithium realized something. They had been accepting arrangements that no wealthy nation would ever accept. An American state wouldn't allow a foreign company to extract oil, ship it abroad, and send a small check back. European countries don't let outside middlemen take 20% of their mineral wealth. Yet resource-rich African nations had normalized these arrangements, treated them as inevitable. Ghana's transformation became a model. More than just an economic strategy, it became a political awakening. Countries began exploring similar policies: state control of resources, domestic processing requirements, direct revenue capture. The language shifted from "let foreign companies invest" to "these are our resources, and we're managing them for our benefit." This movement had a name: resource sovereignty. And it represented something fundamental: a continent deciding that its wealth should benefit its own people, not just international shareholders. The implications rippled outward. International investors suddenly faced harder negotiations. Mining companies that once dictated terms to weak governments found themselves dealing with nations asserting their rights. The old colonial-era dynamic, where foreign interests extracted resources and left developing nations with a cleanup, began to crack. Not everywhere, not all at once, but visibly, undeniably, the ground was shifting. Ghana's immediate results were staggering. In just 4 months of 2026, the Gold Board and new enforcement mechanisms generated $2.7 billion in revenue. That's not a fiscal quarter bump. That's the difference between running a deficit and building reserves. That's funds for infrastructure, health, education. That's economic sovereignty becoming material reality. But beneath the headline figures, something more profound was happening. Small-scale miners, the backbone of Ghana's gold sector, but long marginalized by foreign companies and middlemen, finally had a pathway into the formal economy. They could sell their gold directly to the government at transparent prices. No more haggling with smugglers at 30% below market value. No more being accused of theft when they sold to anyone but the big foreign outfits. The system that had penalized them for generations suddenly started rewarding them. Employment shifted too. As domestic processing became mandatory, jobs moved from Dubai and London back to Ghana. Refineries, trading facilities, administrative roles. Work that had been outsourced to foreign countries was now staying domestic. A nation that had struggled with unemployment wasn't just collecting more gold revenue. It was creating employment in the gold sector itself. The currency strengthened. When a government has $11.4 billion that previously disappeared, it can manage its debt differently, make different choices about imports and reserves, project stability to international markets. Ghana's currency began to recover not just because of gold revenue, but because the entire nation's financial posture changed. The bleeding had stopped. Were there challenges? Absolutely. Transitioning from an extractive model that had operated for decades wasn't seamless. Some international mining companies, accustomed to favorable terms, became less interested in Ghana. Some smuggling networks adapted rather than disappearing. The Gold Board required competent governance. Mistakes could be costly, but the fundamental trade-off was clear. Losing some mining interest was worth it if the nation kept the wealth it actually had. And the regional contagion effect, that was real. Mali moved in similar directions. Niger, facing international pressure and economic challenges, saw a different model emerge. Resource nationalism could be a path forward. Tanzania began exploring how to capture more value from its mining sector. Not all of these transitions went smoothly. Some faced resistance from powerful foreign interests. Some got entangled in geopolitical conflicts. But the idea had taken root. A nation's natural resources could belong to the nation. This was the hidden revolution in the story. Not just Ghana's economic recovery, though that was real, but a shift in how African nations understood their relationship with their own wealth. For decades, the narrative had been resigned. We have resources. We need foreign investment. Foreign companies will extract them. We'll get what we get. It was painted as inevitable, as the only realistic option for developing nations without the technology or capital to develop resources themselves. Ghana's transformation exposed that narrative as convenient fiction. Technology transfer, domestic capacity building, processing infrastructure. These could be demanded as conditions for resource access. Neighboring countries had already figured this out. Ghana could figure it out too. And once one nation succeeded, others could follow. The geopolitical implications were subtle but significant. When African nations retain more of their resource wealth, they become less dependent on external capital flows. They have more resources to invest in their own priorities. They can negotiate with international actors from a stronger position. A Ghana with $2.7 billion in quarterly gold revenue is a different negotiating partner than a Ghana bleeding its resources to foreign companies. Some called a crisis for international mining capital. Others called it a correction of a fundamentally unjust system. Both perspectives captured something true. For decades, the arrangement had been extraordinarily profitable for foreign investors and extraordinarily disadvantageous for host nations. Ghana's model didn't eliminate foreign investment or mining. It just ensured that the nation captured a far larger share of the value created by its own resources. The fiscal impact was transformative. With billions in new revenue annually, Ghana's government faced a choice: spend it on immediate consumption, invest it in long-term development, or some combination. The pressure was immediate: unemployment, crumbling infrastructure, underfunded health systems. But there was also an opportunity to build institutional capacity that would sustain development for generations. Investments in education could boost productivity. Infrastructure could enable faster economic growth. Health and welfare could create a stronger, more productive population. The money itself was just the beginning. How Ghana deployed it mattered far more. And that's where this story intersects with something larger about development and power. A nation extracting maximum value from its own resources doesn't guarantee development. Norway has done it brilliantly. Nigeria has struggled despite vast oil wealth. The difference isn't the resource, it's the institutions, governance, and choices that determine how that wealth gets used. Ghana's transformation was therefore twofold. First, it stopped losing wealth. Second, and this was still being written, it had to decide what to do with the wealth it kept. That second challenge was harder, more complex, less about policy design and more about governance, corruption, political will, and competing visions for the nation's future. But here's what mattered. Ghana had created the conditions for that second challenge to exist. A nation couldn't build prosperous institutions on a foundation of constant theft. Ghana had filled the holes in the foundation. What it built next was up to Ghana. And watching from across Africa, other nations were making their own calculations. The model was proven. The risks were clear. The rewards were enormous. One by one, the dominoes were falling. Not everywhere at once, not without resistance, but unmistakably, African nations were beginning to understand that their resources could belong to them. This was resource sovereignty in action, not as an abstract principle, but as concrete revenue, actual jobs, real currency strengthening, genuine wealth staying in the communities that owned it. Ghana's story became a map, and across a continent that had been shaped by centuries of resource extraction. That map was suddenly very relevant. The question that echoed from Lagos to Luanda was simple. If Ghana could do it, why couldn't we? And that question, more than any amount of gold, was changing the continent. Because the real heist wasn't Ghana stealing back its own resources. It was centuries of international systems designed to ensure that African nations never quite had the power to demand their due. Ghana broke the spell. And once the spell is broken, it's very hard to cast it again. The $2.7 billion in 4 months was an ending. It was a beginning, a signal that the old arrangements were no longer inevitable, that nations could assert their rights, that Africa's wealth could actually benefit Africa, and that sometimes the most transformative change comes not from discovering something new, but from finally keeping what was already yours. Ghana's gold didn't move. Ghana's understanding of who owned it did, and that small shift in perspective multiplied across a continent. had the power to reshape the global balance of power in ways that would echo for generations. So the question isn't just about Ghana anymore. It's about what happens when an entire continent wakes up to the fact that the rules were never actually unchangeable. They were just accepted. And when you have 1.4 billion people sitting on some of the world's most valuable resources, suddenly deciding they might want to keep those resources, that changes everything.